Welcome to our webinar for housing associations covering the tax issues related to the economic effects of COVID-19. I'm Paul Knight. I'm a partner at BDO leading our social housing tax practice. In this webinar, I'll be joined by Glyn Woodhouse, a BDO partner in our VAT team, and Jonathan Jarvis and John Corris from Devonshire's covering legal aspects. This webinar is specific to housing associations. We do have extensive updates on wider COVID-19 issues on our BDO website, should you wish to go and have a look at those too. Okay, so let's start with some corporation tax points. Whilst it's impossible, obviously, at this point to truly forecast, there is a potential for trading subsidiaries to face a period of loss making. So on this slide, what we're looking at is a scenario where you have a trading subsidiary of a charity who over the period to the 31st of March 2020 has made a profit and has not paid the donation relating to that profit at the year end, as it's intending to rely on the rule that allows you to pay it within 9 months. What you could find is that in the subsequent period, before the donation has been paid, that subsidiary has found its way into a loss position. The critical thing, one of the critical elements of making a donation is it must be made from distributable reserves, and it's therefore possible that by the time you make the payment that you have got to a negative reserves position, which would block the ability to go ahead with that donation. So the really important point here is to consider the timing of those payments. It is, of course, potentially possible that if over the whole of that second period there is a loss, that you could carry that back to relieve the tax on the earlier profit, on the previous year's profit. But it's also possible that by the time you get to the end of the year, the business has recovered. So again, just illustrating the importance of modelling out the timing of any of those donations that have been anticipated and built into the plans for March 20. On our next slide, still on losses, here we have a situation where you've got a charitable housing association with two subsidiaries. One makes a profit and one makes a loss. So here we have sub 1 with making a profit of 120 and sub 2 a loss of 300. Now, we have some options here from a tax perspective around tax management. In the example I've put in the table, you can see that sub 2 has allowed sub 1 some of its loss to offset those profits from a tax perspective. Because that doesn't affect the accounting results, you have a situation where sub 1 will be carrying forward distributable reserves. Sub 2, however, having given away the value of some of that tax loss, will find that in the future, when it goes on to make profit, it will have more taxable profit than accounting profit. So in a sense, absent any other steps taken, we are creating a problem for the future in that approach. And one option here is obviously to allow sub 1 to make a donation like it would do in the normal course of events if all of the group was profitable. That would prevent the mismatch, but that would also mean that the potential tax value of those losses may be lost if sub 2 does not go on to become profitable in the future. It's also possible to use group relief but bring the accounting position back in line with the tax position by having the entities making payments for the group relief. But that is not a straightforward process. There's some complexity in there. And I would suggest it's sensible to model out which of those different versions you're intending to use to try and achieve the best overall outcome across the group. The third point, as forecasts and models change across the group, there's obviously the potential that funding requirements will also change. And where a charity is advancing funds to a trading subsidiary, it's absolutely critical from a tax perspective that the approved charitable investment rules are appropriately considered. So where new funding is advanced, the charity will need to look at the basis on which that decision is made. Is it giving the right return? Is it properly secured? Will it be repaid on appropriate timings, etc.? Clearly, in commercially difficult times, the assessment of that being an approved charitable investment is particularly important, because if that becomes a bad funding option in the future and is written off, the revenue will be looking at contemporaneous documentation as an explanation for why the charity has spent its money in that way. Another critical point here to focus on is ensuring that if management charges from the charity to the subsidiary are not paid on normal commercial terms, that will also be treated as if it were an investment for the purposes of these rules. And so it's important that that too is documented as to why that would be allowed to build as a balance, and the same conditions would be applied to that thinking as would with any other form funding. On top of that, of course, we have transfer pricing to factor in, and the implications on the corporate interest restriction calculations across the group. So there would be potentially some modelling of the overall implication in respect of that to apply as funding changes. On this slide, we're talking about the use of land. So at this point in time, we know that lots of organisations are looking at whether their plans for land should change, and in particular, as I've illustrated on this slide, whether or not something that has been destined for social rent should move into sale or the other way round. This is particularly important from a tax perspective, because as and when the intention changes, that is a transaction from a tax perspective, notwithstanding that there hasn't actually been a disposal of the land to any third party. So we need to be able to see that coming and understand what the consequences of that might be. It's also worth flagging that SDLT reliefs should be checked at the point of changing tenure, as the use of charities relief in particular is subject to clawback. And so it would be wise to check the relief claimed and the consequences of any potential change. And like approved charitable investments, it's absolutely critical here to get the documentation correct. Certainly when the period of time around 2008 and subsequently, there were lots of examples of the revenue coming in to test the basis on which land had moved from one to another type of tenure. And in those examples, the organisations who were best able to present a robust tax position were those that had comprehensive contemporaneous documentation, and in particular covering the tax consequences. So I shall at that point hand over to Glyn.
Cool, and I must say it's good to be working with you again. So my name is Glyn Woodhouse. I'm a VAT partner with BDO, and I head up the VAT services within the social housing space. I'm going to very quickly gallop through the VAT deferment from the government introduced. I'm not going to spend a huge amount of time on this because I'm guessing people are already pretty much aware of it, but any VAT payment falling due between the 20th of March and the 30th of June can be deferred and not paid until the 31st of March 2021. That deferral is automatic, but I would highlight that it's not compulsory. And if you feel that you want to make the payment at this time, or you're better off making the payment at this time, then there will be no adverse consequences for doing so. If you want to do that, then you don't need any pre-agreement, but you still need to do your VAT returns as normal. Obviously, that can be difficult in lockdown, and if you're having any difficulties with that, please then do speak to your normal advisor. as failure to submit is still a default. So we can probably help you if that's the case. But I would say if you are putting your VAT return in, do cancel your direct debit just in case the revenue accidentally take it, because I don't think they have any mechanism in place to stop them doing it. So they've also introduced two new zero rates. The first zero rate is a zero rate for personal protective equipment, and that applies to all supplies of PPE between the 1st of May and the 31st of July 2020, assuming that it's not extended beyond July 2020, and that's entirely possible. The relief applies to all products covered by the recommended for use by the Public Health in England, and covers disposable gloves, aprons, etc. At the same time, they've brought forward the previously announced zero rate for electronic publications, books, brochures, pamphlets, etc. And that's also been brought forward to the 1st of May 2020. So as Paul was mentioning, one of the common impacts of a downturn is that house prices fall, and people's ability to purchase property diminishes. And that often leads to a change of tenure, where schemes that were intended for either outright sale or shared ownership are then repurposed to market or below market rent. If you've incurred VAT on that land and recovered that VAT in connection with the intention to make those sales, then the impact can actually be very large. But there is obviously a smaller impact if there's no VAT on the land, but it's still very relevant to your scheme economics, so it still needs to be considered. So where you've recovered VAT on an intention to either make wholly outright sales or wholly shared ownership, and you're going to move that to either partial rents or entirely rented, then you're moving from taxable to exempt. So on the date that your intention changes, you're going to have to repay the VAT that you recovered in the first place. If you're going to a partial recovery, then obviously you're going to repay part of that VAT. And that applies to any VAT that's been incurred within 6 years of the change of intention. And it's a single change. So what can you do about it? Well, you can consider making a taxable supply to a non-VAT group entity. Obviously, it's important that it's not within the VAT group in order to get that taxable supply. And I would also highlight that many social housing organisations are already set up this way, so that all of the land comes into the development company and is then sold to the appropriate place, whether that be the third parties or into one of the housing associations. You do need to consider the impact that might have, and whether you have any disclosure obligations to the revenue if you're doing that as a one-off. But it would certainly save you an enormous amount of VAT. So what happens if you are changing tenure, but it's just a change of tenure mix as opposed to entirely from one category to another? Well, in that case, I would say you need to look at your partial exemption method to see how that kind of change should be dealt with. In nearly all cases, you'll find that you need to adjust the VAT that you've recovered. So if you were assuming that 50% of the units were being sold and you're recovering 50% of the input tax, then you might have to reduce that to 30% or 20% or whatever the new amount is. If you're on the standard method, you might have to consider the standard method override. That's quite a complicated provision, and I don't really have time to go for it now, but it's worth looking, and it ties in whether the actual use is going to be significantly different to the intended use. If your property is already brought into use, so say you have a block of flats with 100 units and you've sold one of those units, then it's possible that the adjustment will be under the capital item scheme. And that means that you're going to be making adjustments every year for a period of 10 years. So what if the change is temporary? So you have some units and you are going to rent them for a period of time because you can't sell them now, but your intention remains to sell. There is case law to say that actually that you do still get some VAT recovery up front, based on the future intention, providing that intention is still there. And in 2008, the Revenue introduced a business brief to cover that position. I would say that if you're in that position, the important thing now is to engage with the Revenue and see whether they will accept the temporary use. and consider whether actually you're not going to lose the VAT in its entirety. If not, once again, you might be under the capital goods scheme to make any future recovery. So the other thing that often happens at times like this is that there are a lot of developers out there who are trapped in situations with part-built developments or land, and they look to form joint ventures with people that can give them some kind of exit. Now, joint ventures are great from a tax and VAT perspective, but there are some impacts that's worth considering when you're looking at joint ventures. The first thing I talk about is payments between joint venture members. In many cases, these are payments that will trigger a VAT charge, so that you need to look at each one on its own merits. Also, where you're moving land and or supplying services between the joint venture partners and the joint venture vehicle. In most cases, that is going to be supplied for VAT purposes and will have a VAT. Overage payments can be quite complex from a VAT perspective on these things, mainly because the land has often changed in nature between the time when you form the agreement and the overage payment is paid. So often from taxable land to either exempt units or to because they're dwellings. Profit share arrangements often fall foul of VAT in these arrangements, so it's important to consider their nature when you're looking at the joint venture arrangement. Where you don't have a formal joint venture vehicle, but it's going to just be a contractual joint venture, then you've got to think about jointly owned land and jointly developed properties and how those payments are going to be treated for VAT purposes. Often it will lead to the requirement to register for VAT as part of a pseudo partnership or something similar. But it's really important to think about that at a very early stage, because contractual joint ventures are nearly always problematic. And finally, I would just mention the basic treatment of the joint venture vehicle. If you have a joint venture vehicle like an LLP, then it is a taxable entity in its own right. It does require VAT registration, and it does require somebody to put the VAT return. So it's important to get that dealt with your joint venture partners up front. So one of the most common issues with these types of joint venture is a barter transaction. And what often happens is that a developer is giving you something in return for something else. There's no payment for that, but it's still treated as a supply for VAT purposes. And the point that I would make here is that if you recognise these things up front, then normally the VAT can be managed and it doesn't lead to additional irrecoverable VAT. But it's almost impossible to sort out retrospectively, and retrospectively can lead to some very, very large VAT liabilities. And I would say if you have any situation where you have land transferring at any kind of undervalue, whether it's free or for a lower value, and there's free supplies of services, then the most likely outcome is that there is a barter transaction somewhere underpinning that, and that I would suggest that in that case that you check it out and recognise those and tax them appropriately. Got a very, very quick example, and that is a developer is providing land to a provider of social housing. The registered provider of social housing is going to build some units for its own use, but it's also going to provide either construction services or a completed commercial building back to the developer. In that case, you have a transfer of land from the developer, and the first question that should leap to mind is there VAT on that land? And if so, what is the treatment in the housing association? Are you going to get a back cost that you can't recover? And can you recover that? Are you going to have to charge VAT on the supply back? The freehold sale of a commercial building is subject to VAT compulsorily. And if you're providing construction services, and as in, you're not actually selling the building, but you're constructing it for the developer, then that is almost certainly going to be taxable, and you're going to need to raise a VAT invoice for that. I would also say, what is the tax point for these supplies? The key here is that when you sign the joint venture agreement or the development agreement, the transfer in rights tends to happen at that point. So for VAT purposes, that is the tax point, because that's the point when you've been paid for the services that are going back the other way, even if those services are not happening for some time. Finally, I want to briefly mention the domestic reverse charge from construction services. Now, this was a change that was introduced, was supposed to be introduced last year, but was delayed until the end of October this year. It's possible that it'll be delayed again, but if it's not, then what happens is the responsibility for paying the VAT will sit with the purchasing business, not the supplier. So down a construction chain, that will mean that the supplier of the construction services will not need to charge VAT. The recipient of those services will self-account for that VAT themselves. Now, for most of the people on this call, we are going to be what's known as an end user, and therefore the normal VAT rules will apply to the supplies to you. So you will not have to account for this under the reverse charge, but you will need to make sure that the developer understands what the liabilities are so that they can charge you the right amount of VAT properly. The real problem here for the sector actually is a commercial one, in that an awful lot of the construction businesses down the chain will be relying on the VAT to underpin their cash flow. Once this advantage goes, they are going to be very, very tightly constrained for cash, and they're going to find it very, very difficult to deal with that. And if you're not careful, you can end up with a supply chain which is collapsing, and which is obviously in nobody's benefit. So you may want to think about accelerating payments down that supply chain. So I think that's all for me. And I think I will just like to hand over to Jonathan Jarvis from Devonshire to pick it up from there. Thank you.
Thank you, Paul and Glyn, for the earlier comments. My name is Jonathan Corris. I'm here with my colleague, fellow partner Jonathan Jarvis, two partners at Devonshire Solicitors. We've been asked to talk about some specific matters that we're seeing in the marketplace at the moment, have come about mainly as a result of COVID-19 and in some part due to market conditions that are already starting to come into place and impacting upon RPs. We're not picking up on all the things that are COVID-19 related at the moment that could be impacting the sector. Our colleagues are currently running a number of webinars, and if there's any other further queries in any other areas, please don't hesitate to contact Jonathan or myself, or to go directly to our website for further information. So moving on to the points we're discussing today. We've been asked to look at development activity, in particular, as I said, what's currently going on within the marketplace at the moment. We're going to look to focus on some of the potential mitigation measures that are currently in place. One of those, which is a popular one already, is changing tenures. So looking at the variety of tenures you may have on your schemes, in particular if you have a site which is high on market sale, looking at what flexibility you can put in place there for shared ownership, or potentially the application of grants and changing to rented-based products. We'll come into further comments on that, particularly from my colleague Jonathan in a moment. Supporting subsidiaries, it's a big point that the regulator's been keen on for a while as part of their IDAs. He's looking at how subsidiaries and group structures are able to manage during stressful times. It's all part of the stress testing exercise, and we understand there's a particular focus at the moment on looking at those subsidiaries that potentially have highly geared or high levels of market sale activity at the moment. There's also looking at the shared ownership product. While there's been a higher percentage of market sale within clients at the moment, shared ownership, it was also forming a large part of a number of RP's programs, and there's also a large amount of income that's anticipated to be received from those. There's looking at potentially the market of shared owners. As a side point, we've actually seen that shared ownership sales have been continuing at fairly high rates given the time of year in any event, and that the embracing of other technology has helped, but there are potentially options to look at the product itself and expand the market associated to it. Just wanted to put two comments on for two other things that we're seeing at the moment. We're not going to go into further detail, but it was just to talk about mothballing of sites. We have, of course, seen that clients are looking at potentially slowing down on sites or not bringing sites forward at this present time. There are, of course, on-costs in relation to holding on to a property and not commencing with development. Those could be planning provisions have been triggered, associated costs with that, security costs. It's important that when considering a mothballing of site, that the original purchase contract is reviewed and the terms upon which you hold that land. If, for example, there's an obligation for you to start on site by a certain date, or penalty payments or LADs, these would all need to be considered prior to mothballing a site. We've been working with a number of clients in relation to looking to put in place pre-construction service agreements, PCSAs, instead of full building contracts to do initial works in order to make a site safe and also viable for implementation at a later date. For example, demolition to mitigate the risk of potential squatting and other on-costs that could come through, and doing those works now so that the site is ready to be brought forward at a later date. There's also potentially the looking of doing minor works for implementation of a planning permission. Typically, a planning permission will only have a 3 years of validity from the date it was granted. It's therefore important to make sure that any timescales associated with planning are monitored so that you don't find yourselves in trying to reinvigorate a site that no longer has a valid planning ticket for it. And the other one, just a very niche one, is market slowdown provisions. Homes England and GLA, I'm particularly talking about here. There's also some provisions in TfL and certain NHS, particularly key worker schemes that we've seen. Is just bear in mind that look at the market slowdown provisions in those contracts if you're having to slow down construction on site or you're worried about sales rates. Important to also check against the overage provision. It may be now an opportune moment to talk to Homes England GLA about the position under contracts and potentially look to agree variations where you think further land payments may be due, but you need to defer those from a cash flow perspective. From my understanding, they are open to conversations. It's just making sure that you're able to go there with the correct supporting information. And before you do, you've explored any potential mechanisms you may have within the contract. Homes England, for example, standard form build lease will require works to be done by certain dates, otherwise rights of forfeiture arise, but there are ability for extensions of time. One thing we would say is that COVID-19 is not always an extension of time under contracts. It's important to actually look at the circumstances that relate to the situation itself and to focus on those as part of the matter. Moving on to changing tenures, just one point I want to make, I think I've already touched upon it, is checking when you're looking at changing a tenure to the planning position. While Homes England and other grant bodies will be more than happy for you to change tenure from shared ownership to rented, one of the key things is to double check is actually that you're able to within the planning permission. Typically, particularly on section 106 stock, if you bought up one of the main developers, such as Bloor, for example, that would normally have a covenant in there that you're to use the units in line with the section 106 agreement, as long as it's enforced. If the 106 doesn't allow you to change tenure, you could find yourselves in potential breach situations, not only under planning, but under your original purchase contract. So before immediately assuming you can change tenure, it will be necessary to check not only 106 and planning, but also your acquisition contracts. And in some very rare cases, we do sometimes see covenants within transfers limiting the use of the properties, which could therefore give rise to a breach. Over to Jonathan.
Thanks, John. John's mentioned one of the key considerations that the board of an RP will need to bear in mind in determining whether changing tenure is in its best interest. Ultimately, that's the test that the board is going to have to reach or come to a conclusion upon. It's important to recognise that changing tenures within the development activity of a group is likely to involve arrangements between both the RP, which may be a charity, and its trading subsidiary. And the question that the RP's board must always hold on to is the question of whether the decision to change the tenure is in its best interests. That analysis is particularly acute for charities, where the question of whether there's a benefit to a trading subsidiary is more than incidental. So all of these factors are going to have to be part of the board's analysis. It's entirely feasible that changing tenure is the right thing for the organisation to do, but make sure that the board understands and owns that process and recognises that it has weighed up all relevant factors in determining whether that decision is in its best interest. And what are those other factors? Well, obviously we've heard from Paul and Glyn on the tax and accounting implications. They will have to be an integral part of that analysis. Likewise, you're going to have the question of what the impact of those changes are going to be on your loan covenants. There may be, as a consequence of that, implications for the arrangements that you struck with the subsidiary in relation to investment and consideration of impact of this decision on financial covenants will form part of that analysis, as will the question of what you're planning to do with the properties that you're now changing tenure for. So particularly relevant in this context for RPs is that if they are thinking of moving properties from shared ownership or from market sale into rented products, who, for example, is going to own those properties and let them out? Is it going to be the RP, or are you going to leave those, if they were market sale properties, within the trading subsidiary? The relevance of that, of course, is the question of whether the rent standard is applicable. It will be if the property is within the RP's ownership, and if the property constitutes social housing, which obviously, as you will know, is low-cost rental accommodation as defined in the 2008 Act. Important to ensure that if you are not letting the property at market rent, perhaps justifying it as a financial investment by the RP, that you are facing the prospect of that property becoming social housing. And once it is social housing, under the relevant legislation, it stays social housing unless one of the exemptions applies, such as a disposal to another entity. That will mean that you've got to have regard to what the rent standard requires in terms of the rent that you set. It's not going to be possible, and something to bear in mind in terms of exit strategies. You can't then move them from below market rent to market rent at a later date within the same entity's ownership. All of those are relevant considerations, but ultimately the question from the board's perspective is, has it weighed up all the relevant factors, and has it concluded, acting reasonably, that the decision is in the best interests of the RP? And if it is, it can proceed on that basis. Second mitigation measure that was talked about by Paul and Glyn was the question of supporting subsidiaries. And the analysis there, or the question for the RP, is very similar in terms of analysis as to whether it can provide that support to the subsidiary. And they've talked about what the tax and accounting implications would be of that. And again, that's a vital component. But ultimately, it does again come down to a question of whether the board, acting reasonably, is satisfied that the decision to provide that support, whether that's in the form of further investment or whether that's in the form of reprofiling repayments, extending repayment dates, or providing holiday payments, all of those, or indeed acquiring additional units that are otherwise not earmarked to be acquired by the RP, are all going to form some form of support, theoretically, by the RP. And understanding whether any of those decisions are in the best interest of the RP forms the ultimate assessment. And in doing that, again, we come back to the question of whether there are any implications with that support in terms of restrictions in loan covenants, in terms of provision of further investment, or whether indeed any other form of financial support, recognising that some loans, particularly those of the AHF, can widen the definition of financial support beyond covenants that you'll see in other loans. Again, the impact on financial covenants will need to be considered, particularly if there is an impairment on your investment as a consequence of the decision that you've reached. And ultimately, the question from a regulatory perspective, as much as a legal one, is whether this is a decision that involves some form of inappropriate benefit by the charity to the subsidiary. In that sense, there's a synergy between charity law and that of the regulatory regime, which, as the slide identifies, specifically refers to, in the Governance and Financial Viability Standard, a requirement to ensure that there's no inappropriate benefit provided to a third party, or one that the regulator could reasonably deem to constitute an inappropriate benefit. That said, if the benefit is clearly and reasonably one that is fundamentally or focused towards being of benefit to the charity, and that could be, for example, ensuring that the failure of the subsidiary doesn't adversely impact on the RP or charity, or indeed whether the failure would have longer term implications for the charity in terms of its ability to meet its development programme, given that for many the provision of cross subsidy through private sale is integral to delivering the number of affordable housing units that form part of their programme. All of these quite legitimately may form part of the analysis that the board considers to decide whether to provide that support is in its best interests. Finally, in terms of mitigation measures that we were touching upon on the earlier slide, is looking at the shared ownership market. And as John rightly says, that market seems to have held up very well today, but it's entirely possible that there may be a blip in the mortgage finance market over the coming months. And one of the models that might be worth exploring is the question of whether the RP is able to facilitate the shared ownership lessee acquiring the lease, albeit with a deferred period in which to complete on the minimum 25% interest, which is the grant condition requirements under the Capital Funding Guide. Certainly, we've got one client looking at this at present and is in discussions with Homes England to establish that whether Homes England are comfortable with the model. But what it would enable is the shared ownership lessee who might otherwise have been eligible to access the scheme is capable of supporting the payments due under the shared ownership lease, but can't secure the shared ownership or the mortgage finance needed at that given time. That lessee would then have the opportunity to enter into that lease with a commitment to buy the 25% interest within a given period and at a time that suits them to complete on that interest, with that purchaser simply paying for the additional cost to the RP of funding the deferred acquisition until the point at which the 25% interest has been acquired. Now, we recognise that that is capital intensive from an RP's perspective, so it may not be a solution for all, but it might be a solution for those that don't necessarily want to reduce the number of shared ownership units in their programme and simply converting them to rental. Food for thought, nonetheless.
One of the points we were asked to pick up on is what are we seeing in the marketplace in relation to those looking to still maintain delivery. Our clients still have a strong commitment to making sure that they're achieving their business plans and, more importantly, delivering housing to those in need, which requires a variety of different tenures. As already commented by Paul Glynn and touched on by Jonathan, joint ventures is one of the points that is still very much in an active market at the moment. I think everyone thought that loads of things would go quiet, but actually we're still seeing joint ventures as being one of the agreed solutions to be able to move forward on a number of schemes. And in fact, some schemes that may not have necessarily been available under a joint venture basis are now being brought forward to the market. Not looking to go through the structures and the mechanics of how joint venture operates from a legal perspective at this point. More than happy to pick that up with anyone if they'd wish to discuss. We just thought we'd go through what we're seeing in the market. RP and developer, which is the most common approach and has seen exponential growth in the recent years. We've acted on a variety of different kind of joint ventures between RPs and developers. Still very active. At the moment, what we're seeing is people are looking at those that are in place, and it's bringing them board, testing those mechanics and mechanisms that were put in place in relation to how decisions are made and how boards operate. From what we're hearing in the marketplace, those procedures are working fine. So actually it's given a bit more confidence as to how these would work going forward. We're also seeing a growth at the moment in multiple RPs, provides an opportunity for strength of RPs. So what we're seeing here is a number of RPs are coming together to bring forward a joint venture to deliver a scheme. This could be in relation to stalled schemes. We're also now seeing it in relation to schemes where RPs were originally looking to deliver a high level of market sale, or there's a large number of units on themselves. And instead of actually partnering with a developer, they're looking at actually, can we deliver more affordable on it? And actually, would it be better if we mitigated the exposure on there by two RPs working together? This is still an emerging growth area, but one that we see huge potential within. RPs with local authorities definitely was already in the growth area. We are still hearing commitments that our local authorities are looking to bring forward on this basis, and there are a number of schemes on the board at the moment for it. There are challenges, as always, within local authority schemes, but it's definitely still seen as an area to go forward. We're also seeing local authorities consider as to how they may be able to bring their housing companies on board now. Maybe being able to bring a level of financing to help mitigate potential sales exposure by changing tenures, picking up from Jonathan's earlier point, and looking to actually sell a proportion of a scheme back to the housing company, which helps in funding situations. Also, we're seeing RP and investor. By this, we're touching upon the for-profits. So the for-profit sector is seeing a large growth, and actually following on from Jonathan's earlier comments on shared ownership, we're seeing investors looking still actually hungry to acquire shared ownership units that are coming forth to the market now or in the short or long term. It could be a consideration for an RP to think about forward selling some shared ownership stock that's constrained by 106, and then potentially it gives you more flexibility on the change of tenure on market sale, or may actually help to mitigate your cash exposure to that scheme. In particular, say a long-term regeneration project could actually help in reducing your peak debt and then helping with the amount of cash that's having to be put in subsidiaries and impacting on your wider group. This slide is actually a slide that we used before, just in connection with JVs, and I say before was before the COVID-19 and the current circumstances. We haven't added COVID-19 as a new thought bubble, as it were, as a consideration, because it actually impacts upon all of them and flows through all of it. Understanding where your JV partner is in relation to their business plan, how they're proposing to weather the coming months, how they are looking to actually still provide the services. Do they have the staff able to deliver, or have they furloughed most of the people you would need to bring forward a scheme? Getting to understand your JV partner and the key considerations that impact upon a scheme, in particular, what are the government arrangements? How are you looking to acquire the site? And you defer land payments? These kind of questions all still need to be raised, but with an understanding, you truly need to understand, are the other side going to be there? And as part of your stress testing internally, we recommend looking at potential reduction in sales values, or more importantly, a delay in cash and sales rate. Modelling these will help with you referring the matter back through any IDA to show how you've stress tested it and made sure that your subsidiary, which should be part of a JV structure normally, is able to weather any potential slowdown or impacts within this JV without significant impact upon funding covenants and obligations elsewhere within the group. One of the points to pick up within the previous slide was procurement. At the moment, we are seeing a number of people looking at their existing schemes that they were going to bring forward themselves and thinking of bringing on board a JV partner to deliver them. As touched upon, that can be a great benefit to bring a scheme forward. However, it's still important to note that the procurement regulations have not been altered or relaxed, and therefore any scheme that's currently held within an RP, it'd be necessary to consider at a very early stage that you're complying with the procurement requirements and looking at the mechanisms you have to work with within that. One of the key points is if you're looking simply to sell land to a partner, potentially there is a route that does not get caught within the JV, within the procurement regulations. However, it's always important to look at the wider picture and what you're looking to obtain out of the scheme. If you're looking to take the affordable units and a high percentage of units back to change tenures, then there may need to be a different consideration and viewpoint taken in relation to that. There's also a position to consider your frameworks. Do your existing frameworks for contractors meet your requirements now or for your upcoming business plan needs? It may be actually while you might already have existing frameworks in place, which give you the flexibility to call off contractors as you need, you could do with greater flexibility and an ability to call them down for a JV partner. Or, given current circumstances, do they still meet your requirements to be able to be on your panel? And do you need to potentially reconsider rerunning the exercise? While this can sound a daunting exercise to do, typically actually we can see frameworks created in a period of 3 to 4 months. And at the moment now, we're finding that clients have the staff necessary to focus on actually providing the documentation and requirements needed to be able to bring forward a framework as swiftly as possible. That's the end of our comments on these points for now. So we'll pass back to BDO and look forward to questions at the end.
Thank you, Jonathan and John, for that. So that's the end of the presentations section. We'll now move into the question and answer session where we can answer any questions that have been coming through during the presentations.
So let's kick off then. One of the questions that's come through, I'm going to start with you, Glyn, just so you're aware, is on the shared ownership, the modified shared ownership point that Jonathan was making around the potential model where it only takes 5% with an obligation to take a further 20% in due course. The question here is, does that impact on the VAT treatment with regards to recovery of VAT on that type of shared ownership? So, Glyn, if you could talk to that point, and then I might just chip in with some corporate tax thoughts too.
Great, thanks, Paul. Yeah, I'll try to. It's actually a really, really good question. The VAT treatment of shared ownership comes out of a piece of guidance within the revenue's internal guidance, which accepts that in a case of a shared ownership deal, all of the VAT that's incurred up until the point of that deal is effectively used up in the first tranche disposal. Now, there's nothing in their guidance to suggest that there is any limit on that. So, even a 1% could technically be seen to be a shared ownership. But at the stage, it's very, very difficult to know how they would react. If they feel that this has gone a little bit further than they would, they don't actually need to make any legislative changes to attack that. And what I would suggest to people is to make sure that the revenue is on side for it being treated as a shared ownership under those arrangements. My personal view is that they should be, but it's far from clear, I'm afraid.
Great, thanks, Glenn. I mean, I would just add, corporate tax-wise, typically treat first tranche disposals as trading and further tranche disposals as capital. That's the norm for most organisations. It would be an interesting thing to get into the contractual position on this, I think, to make sure we understand whether the 20% element that we have obliged the purchaser is obliged to make falls into the trading part or the gains part. My instinct says it would probably take us to trading, and so the position would be quite similar to the current position, but I would suggest that needs some fairly close attention to get the right answer. Okay, moving on, I have a question here about, this is around supporting trading subsidiaries. And is it acceptable to reduce interest charges from a charity to a subsidiary temporarily to help see them through market conditions? I think that's a legal bit. I'll give you a second to think about that, Jonathan and John, while I just say from a corporate tax perspective in answer to that. You'll need to think about the two elements of approved charitable investment. So if you change a loan in a significant way, you should assess that as if it were a new approved charitable investment decision, and therefore go through the same thinking at that point that you would have done when you advanced the loan in the first place. And then you'll be looking at all the normal characteristics and factors of an approved charitable investment and testing it against that. I mean, in principle, it's perfectly feasible that if overall that presents the best outcome for the charity because it allows the subsidiary to bounce back in due course, then I can definitely see there's a potential to get comfort on that leg of it. And the other element to consider is transfer pricing. Generally, if you're reducing the interest cost in the tax-paying subsidiary, that's going to be less of an issue than where you're seeking to increase it, as it's obviously reducing the amount of tax deduction being taken in the subsidiary. But I think it's worth looking at all of that together when you're looking at how you're trying to manage the subsidiaries in a group through this period, because it could interact with things like the way group relief is used and the various different levers that you can pull to try and manage that. So there are corporate tax considerations, but potentially should be able to navigate through. Jonathan, perhaps just comment on the legal?
Thanks, Paul. Well, in a sense, as I indicated on the presentation, the analysis is very similar. You have to take into account what the tax and accounting implications are. But ultimately, if the decision is that, or the board acting reasonably is comfortable that to agree a reduced margin for a period of time is in the charity's best interest, and as I say, that could take account of what the implications would be of the failure of the subsidiary and the longer term implications for the charity's growth plans, then it's entirely feasible from a VARI's perspective for a charity to agree that
reduced margin for a period of time.
Yeah, that's great. Thank you, Jonathan. I've got a very specific VAT one here for you, Glyn. You talked about domestic reverse charges. The question is, does that hit or affect development companies?
Yeah, it's actually another very good question. The answer is probably not, depending on how you set it up. Development companies, there's a get out for end users. So if you are the end user of a qualifying service, so that's a construction service, so you are the one who's having your building built, then you do not have to use the domestic reverse charge. You pay VAT in the normal way. That same treatment extends to anybody who is connected to you, that is buying in services to resell onto you as they are bought in. So in the normal course of events, with a development company buying in those services and then selling them on to the end user, because they're connected, is going to be fall outside the domestic reverse charge. Of course, we've all seen development companies that are not set up quite like that, and I think there is a question mark as to whether, you know, if you've got a less traditional development company, whether it would apply. With luck, the government will put it back again, given the financial pressures anyway. But yeah, I mean, the short answer is no, it does not apply.
Okay, great. That's helpful. Next question is about changing tenure. I'm reading this as a tax question, but I think there may be some legal comments on it also. If we transfer some properties that were built for sale into rental on a short-term basis with the intention of selling later, does this qualify as a change of tenure? So I'll answer that on the corporate tax side. This is one of those areas which is driven by case law, as opposed to any specific legislative rule that you can simply lift and apply. So the move from something being trading to capital is difficult. It's particularly difficult in land, where you can obviously use land for both of those purposes, and most housing associations do. So you will have to look at the facts in the round. It's quite possible, and there's definitely case law that supports a very short-term rental period where the ultimate intention to sell is maintained throughout that period, that the asset has never moved. And therefore there may be an argument that it retains trading stock status throughout. But clearly, if that starts as a short-term intention, but then you end up renting it for a number of years, that's going to put a lot of pressure on that initial analysis. It comes back to the point I made in the slides on the corporate tax, that you really need to just get the documentation absolutely clear and understand what you think the tax consequences are at that point, so that you can go back to that initial assessment if circumstances change. And so that's the really critical point here. I don't know, Glyn, is there a VAT comment to make to that point?
Yeah, there's quite a lot of that comment on that one. Back in the last recession in 2008, the revenue released a business brief basically saying that if you're temporarily having to use a building for rental, while you're still out there looking for a buyer, then they would accept that initial rental period should be ignored when you're bringing in the VAT rules. Now, obviously, that was a very, very specific business brief, and that related to the trading conditions after 2008. And they've not done anything similar yet, although it's entirely possible that they will do. There is some case law to back it up, but we've often found that in practice, when you try and claim with the revenue that actually something is only temporarily for exempt use, and that exempt use should be either ignored or you have to actually make some kind of valuation of that against the long period, is actually the conversation ends up very, very similar to a capital goods scheme. What I would say is it's well worth looking at, and it's well worth looking at in some detail, when that arises, because just simply accepting that the first use is exempt and therefore we can't recover anything probably doesn't lead you to the right answer, at least not the answer you're going to want. So you're going to have to start looking at other ways of trying to do that. So yeah, really, really interesting from that perspective.
Yeah, that's great. Thanks, Glyn. John, is there any legal comments on very short-term tenure change?
Thanks, Paul. The only one, if you're looking at market sale to rental, then it's unlikely there's going to be potential trips from a legal perspective. But always check purchase documentation. If you're talking about a shared ownership sale to look into another affordable product, as commented in the slides, we'd need to check against any Section 106 or purchase contract to make sure there's no covenants or obligations given to anyone elsewhere as to how you're going to use those units. But that's it from a legal perspective.
Yeah, that's great. Thanks, John. We've got a few other questions here that tending to be quite specific ones. So I've tried to pick off the wider ranging thoughts. We have run out of time. This has taken us up to 1 o'clock as advertised. So I'm going to draw the Q&A to a close there, and just remains for me to say a massive thank you to Devonshire for joining us for this. Jonathan and John, thank you very much. And obviously for Glyn as well, joining me for all the VAT comments. The webinar will be available to download in due course, and so we can share that with anyone else that you would like to have the opportunity to see it. Feel free to go and connect up with that. And other than that, thank you very much for joining us, and have a great day. Thank you. Bye.